Good morning, students. I am C. Ankit Sharma, your income tax faculty for today's session again. So we were discussing the provision of capital gain chapter. This is our second session for this topic. In the first session regarding the capital gain, we discussed the basic part, that means the definition of capital asset and the definition of transfer. Why? Because capital gain is chargeable if there is a capital asset and there is a transfer. So what is the exact meaning of a capital asset and what is the exact meaning of transfer? We discussed that in the last session. Beside that, we also discussed the provision of long-term capital asset and short-term capital asset and the cost of acquisition topic also. And today we will be discussing the provision under section 47. That means those cases in which transfer will not be regarded as transfer. So section 47 will explain cases that is technically fall in the definition of transfer under section 247, but specifically excluded from the definition of transfer. That means in these cases, there will be no capital gain. Or to understand in very easy language, we can say section 47 excuse me, section 47 technically going to explain the transfer, those are exempted actually. So if any transaction falls in the definition of section 47 cases, that means that is transfer, but there will be no capital gain. Okay. Then we will move on the other provision regarding the advance money forfeited, etc., etc. And today, with the class start, I am going to take a MCQ test. And do not worry, this MCQ test do not need any pen or calculator, etc. It's based upon the definition what we have discussed this till this point of provisions in the first session, like what is a capital asset, etc., etc. So you might not need a calculator, etc. It's very easy. So before starting the class, okay, there are good morning wishes from Mr. Sohail, Neha, Devraj, Parth, Mamta, Bilas, Sushil, Ajay, Mohammed, Srinivasan. Good morning. Srinivasan is good morning. PGBP, test your knowledge question number 9, depreciation calculation. Okay, I will explain that, Mr. Srinivasan. Swati Pandey, Madhav, Kadambari, Monica, Divya, Kalasevi, Swati Krishna, Sangite, Mansi, Shreya, Sankaran, Gopinath, Shweta, Pooja, Riya, Girish, Kiran and Vaishali, and Miss Sampurna Roy. A very good morning to all of you. Good morning, Suprabhat, Namaskar, Sat Sri Akal, Vanakkam, Kem Cho, Subha Bakher, Kasakai, etc., etc. So first of all, let me explain the illustration number 9 of Test Your Knowledge to Mr. Venkatraman. He was asking the depreciation calculation in last class also. It's very simple. The depreciation we need to calculate. I guess I don't have the question, I have the solution. So depreciation was like 11 lakh and 90,000 was a value that has been given, opening WDV. Okay. Then there is an asset which is more than 180 days has been purchased, which was 2 lakh rupees. And there is an asset which has been purchased, that is on these two assets, depreciation is going to be calculated with 15% rate. That will come 2,08,500. And on this is going to be calculated at the rate 7.5%. That will be 15,000. So total depreciation as per income tax will be this. This is going to be deducted from the profit which has been given 5 lakh rupees. So depreciation as per account was 2 lakh, that is going to be add back. And depreciation as per income tax will be this much. Okay. I hope it's clear, Mr. Venkatraman. Next is Sampurna Roy is saying, sir, I have a question regarding PGBP that additional depreciation section 115 BAC not availed, but if in previous year 22-23 SSC claim additional depreciation and put to use less than 180 days in current previous year, but in TYK question number 1, the balance additional depreciation is not available. So opening WDV, yes, you are exactly right. Very good question. In the question number 1 of TYK, there must be addition in the case when we fall under default tax regime. In that situation, the depreciation which has been claimed in previous year 22-23 should form part of the opening WDV of the block of the asset. Correct. I've solved that question with that provision only. In that situation, your additional DAP will be there and total depreciation will be 6.84. Yes. So I'll inform the BOS. I have thought that I should inform that this solution should be changed. So I'll talk to the BOS and I will let you know in the next class. But the correct answer should be 6.84 depreciation. In that situation, opening WDV should be 26.25. Okay. So I will let you know very soon. But very good question. Very good query. Next is Kiran. Good morning. Vaishali, Lokesh, Krishna, Retro Banerjee, Santosh, Komal, Tanu. Less than 180 days not mentioned in the question is saying. Let me see then. Question number 9 you are asking. Just a second, Mr. There must be information regarding it, Mr. Okay, question is 9. Mr. Srinivasan, it has been written in the question number 9 that WDV as on 31st March 23 minus depreciation is 11,90,000, correct? Additions during the year used for more than 180 days. So you should understand the question. Opening WDV has been given, clear? And those addition which has been used for more than 180 days has been given in the question 2 lakh rupees. Total addition has been given in question is 4 lakh. So what does it needs to communicate to you? It tries to communicate to you that total addition was 4 lakh, out of which more than 180 days are 2 lakh. So automatically you should understand why I did not say that total 4 lakh is more than 180 days, because out of these 4 lakh addition, 1 lakh 180 days more additions are only 2 lakh. So that means silently it's try to communicate to you that balance is less than 180 days. If the total additions 4 lakh rupees is more than 180 days, then it would have been written over there that total addition more than 180 is 4 lakh. But because it is been given in the question that out of that total 4 lakh, 2 lakh is more than 180, then what does it wants to communicate to you that balance is less than 180 days. So sometime you should understand the silence also of a question. Okay, I hope it's clear now. So Santosh, we have cricket match in Calcutta. Okay, very good. Next is, so I am going to take a MCQ, but before that, thought for the day. And it says, tough time never last. Tough times never last, but tough people do. So the time may be hard for you. Things might not be in your way. But if you're strong, if you are tough, then definitely things will be in your way, later or sooner. So time will not always be remain the same, whether it's bad or good. But at bad times, you have to be strong. You have to be tough. The only way to come out of any bad time is that you have to be consistent. You have to focus. You have to work hard for your goal. So time will change. Like we say that tables always turn. In the same way, tough time never lasts, but tough people do. And you all are, I believe, tough people. You will come across, you will come out of this tough time, whatever you have in your life. So that was the thought for the day. And now the MCQ. Very simple question, very simple question. So we do not need calculator, etc. You can answer these questions without calculator, etc. So that is the moment of truth. And this is question number 1. Very simple question. So I expect you to give the answer very fast. Okay. Which of the following will be treated as long-term capital asset after 12 months? We have discussed the definition of long-term and short-term capital asset. So you have to answer me that which one of this is a long-term capital asset after 12 months. Come on, fast. Pooja is asking, sir, if a person purchased a machine in previous year 21-22 for 1 lakh, I guess it's 1 lakh. Yes. And that year he opts section 4480, that is presumptive taxation scheme. Okay. And in the year 23-24, he does not opt 4480. What will be the WDV on 23-24? His depreciation will be deducted for 21-22 and 22-23. Yes, exactly. The WDV will be reduced, assuming that if he or she would have been claimed the depreciation, then what should be the WDV for the current year 23-24? When you claim, when you declare your income under section 44AD provision or 44AE or ADA, then the WDV will be reduced. You cannot claim the depreciation. You cannot claim the depreciation because the specific percentage will be your profit. But the WDV will be always reduced every year, assuming that if you would have been claimed the depreciation, then what should be your WDV? So correct, the WDV will be after reducing the depreciation if you would have been claimed in 21-22 and 22-23. So in 23-24, you can only claim the depreciation after reducing the depreciation from the WDV. Okay, Ms. Pooja? So the correct answer is, of course, option number A, that is listed share. Listed share become the long-term capital asset after 12 months. Question number 2, kindly read this and give me an answer as soon as possible. Okay, question number 2, it's also again the regarding the cost of acquisition. The question 1 answer was A. Now the question number 2 regarding the goodwill, trademark or brand name, right to manufacture, right to carry on any business, etc. What is the correct answer of question number 2? The correct answer of question number 2 is again A. Okay, well done. Third, which of the following is not a capital asset? Very simple. The correct answer is, of course, option number C. Point number 4. Transfer does not include. What does not include transfer? Extinguishment, gift, sale, or none. Which of the following does not include under the definition of transfer? Whether it's A, or it's B, or it's C, or it's D. Correct answer is, of course, D, because extinguishment, gift, and sale all includes in the definition of transfer. Okay. Gift will be exempted in section 47, but it is a transfer as per section 247 definition. Okay. Next, kindly read this and give me the correct answer. I'm glad that you all are giving the correct answer almost in every question. Very well done. Question number 5. Shreyas, it's not B, it's not gift. In question number 4, it will be none, D, because gift is also a transfer, but it is exempted later. So we are not asking it's taxable or exempted. We are asking that whether it's included in the definition of transfer or not. So we have discussed that gift have included in the definition of transfer in the term relinquishment. Okay. So question number 5, kindly send the correct answer. The correct answer is, of course, C. Well done, Miss Mamta. Mohammed Suhail Swaroop is giving the wrong answer. Mr. Swaroop, Suman, correct. Well done. It's 6. If goodwill of a profession which is self-generated is transferred, there will what? Kindly send the correct answer. Practically, we cannot transfer the goodwill of profession which is self-generated. Okay. But if it had been done, then there will be no capital gain. It will be exempted because that has been excluded from the definition of transfer. So if in any case it is possible, then there will be no capital gain. Correct answer is B. Question number 7, correct answer, kindly send. Question number 7, correct answer is of course A, because car is a personal asset and it's movable also. That is not covered under the definition of capital asset. So there will be no capital gain. Well done. Everybody has given the correct answer in question number 7. Question number 8. We have a 12 question in this MCQ sheet, but we are discussing only till question number 8. The rest 4 will be discussed after completing the definition of section 47. What we will be discussing today. Okay. Because those question MC 9, 10, 11, 12 related to numerical point, which will be discussed under section 47. So question number 8, kindly send the correct answer. Any commission, brokerage, which has been paid at the time of transfer will be deducted from the sale consideration as expense on transfer, but any commission, brokerage, etc., if it has been paid at the time of purchase, that will be the part of our cost. That will be the part of our cost of acquisition. Okay. Because any expenses till put to use of the asset become the part of the asset. In the same way, any brokerage, commission, etc. has been paid at the time of purchase. That will form part of our cost of acquisition. So let me see the correct answer of question number 8. The correct answer of question number 8 is option C. Somebody say A, somebody is saying B. No, it's option number C. Why? Because the asset has been purchased after 1st April 2001. So we do not need to compare it with the FMV. Only those assets need to compare with the FMV which has been purchased before 1st April 2001. So in question, maybe examiner will give you FMV on 1/4/2001 for also those assets which has been purchased after 2001. So you need to ignore the FMV in this case. So definitely the cost will be 10 lakh and commission brokerage will be 1 lakh. Total cost of acquisition will be 11 lakh rupees. I hope it's clear. Yes, option C is the correct answer. Moving on to notes. So we are going to discuss the provision, that is cases in which transfer is not regarded as transfer under section 47. There are certain cases in which there is transaction, in which there is transfer of ownership, but still it will not be treated as taxable capital gain because it has been removed from the definition of transfer. And most of the cases are those cases in which government knows that they will not be able to charge any tax because might be cases which result in loss. Like first one is distribution of asset at the time of partition of HUF. So it says if there is a partition of HUF and at the time of partition, if assets has been distributed to its members, so technically there is change of ownership, but there will be no capital gain chargeability because this transaction has been excluded from the definition of transfer for the purpose of chargeability. So it is a kind of relinquishment. If you can see, that is a kind of partition, means a kind of relinquishment, because in this case, HUF transfer its asset to the members of the HUF and do not charge anything, any sales consideration. That is a partition of asset into the family members. So because there will be no technically sale consideration, so if we would have tried to calculate the capital gain, so there will be sale consideration always nil. There will be cost, and if we deduct the cost, there will be always loss. So to avoid that loss, income tax remove this partition from the transfer chargeability provision. So if any asset has been transferred at the time of partition from a HUF to its member, that is not going to be taxed or chargeable under section 45 for the purpose of calculation. That is transfer, but technically that is a exempted transfer. Understand? It's very simple. Again, in the case of transfer of capital asset under a will, gift, or irrevocable trust. Irrevocable trust means donation. So if we transfer our asset, that is also gift, will, and irrevocable trust also, they are also part of relinquishment. And in all these will, gift, or irrevocable trust, there will be again no sale consideration. If I'll gift a property, Mr. A gave a property gifted to his son. So in that case, there will be sale consideration 0. And there will be cost which has been paid by Mr. A at the time of purchase of that property. Suppose 10 lakh. So there will be always again loss. So in case of partition of HUF, will, gift, or irrevocable trust, they all are relinquishment. Ownership is transferring, but there will be no sale consideration. So that will always result in loss. So income tax has been exempted these kind of transfer, whether it's will, gift, or irrevocable trust or partition of HUF. Understood? The next is amalgamation. So I believe that you all know the meaning of amalgamation, or if you do not know, we will explain that amalgamation in the definition later. But it says transfer in case of amalgamation. Practically, what generally happens in case of amalgamation, suppose there is A Limited, it's a company B Limited. Now A Limited wants to amalgamate into B Limited. Clear? So A will be called amalgamating company, and B will be called amalgamated company. Clear? So A do not want to carry on its business and it wants to transfer its business to B Limited. So in that case, suppose A amalgamate into B Limited. So this process called amalgamation. But this is not that simple. It is have various condition, multiple condition you need to fulfill. The basic conditions are all assets of amalgamated company. That means A limited companies, all asset, 100% asset should be transferred to B limited. So all the asset of the amalgamating company should be transferred to the amalgamated company. In the same way, all liabilities of amalgamated company should be transferred to amalgamated company. That means B limited. These transfers should be at book value. The value should not be changed. Whatever value has been in the balance sheet of A limited, the value cannot be changed. It should be on book value. 75% of shareholding should remain same. In accounts, I guess it's 90%, but income tax only considers 75% at the for the purpose of amalgamation. So these are basic three conditions which need to be fulfilled, or we can say it's four conditions: all asset, all liability at book value, and 75% of shareholding should be remain the same in case of amalgamation. So if these conditions are fulfilled, these are just basic condition. In that case, we called it amalgamation. So technically, if you can see, all assets should be transferred, all liability should be transferred, and that will also on book value. So what we are exactly doing, whatever was the balance sheet of A limited earlier, full balance sheet should be transferred just like that to the B limited. So technically, what is just happening, all assets should be transferred, all liability and book value should remain the same. That means value cannot be changed. So technically what we are doing, we are just taking the balance sheet of A limited and it's going to be amalgamate with B limited. So technically what is going to be happen, A limited name will be write off and B limited will be the new name for the company. It's just a basic concept to make you understand what is exactly the meaning of amalgamation. So in that case, why capital gain is here? Because assets are going to be transferred. That's why we are here. So because there are asset and there is a transfer, so both condition of capital gain has been fulfilled under section 45. So there is capital asset done, there is transfer done, but this transfer again is a exempted transfer. Income tax says that if any asset has been transferred in the process of amalgamation, then it will be exempted transfer. But you have to fulfill certain conditions. First condition is that amalgamated company, this company, amalgamated company, that means transferee. A limited is transferor, this is transferee. So amalgamated company should be an Indian company. Amalgamating is an Indian or not does not matter, but the amalgamated company should be an Indian company. The condition number one. In the process of amalgamation, only shares will be transferred in consideration. There will be no other consideration. So we have the condition, what we need to understand. These are the conditions. So first point number 3, it says transfer in case of amalgamation by amalgamating company, that means old company, to amalgamated company, that means the new company or transferee company, provided amalgamated company is an Indian company. So if there is an amalgamation, if there is transfer of asset from amalgamating company to amalgamated company, that will remain exempted if the new company, if the amalgamated company is an Indian company. Clear? We have one more provision in amalgamation. So in case of amalgamation, technically, two assets generally transferred. How it happens? So point number 3 of the definition was saying that in case of amalgamation, if there is A limited and if there is B limited, if this is amalgamating company, in short, AING, If it is amalgamated company, ATED. So if any asset has been transferred in this process, that will be exempted transfer. You need to fulfill only one condition, that is B Limited should be an Indian company. Clear? But in the process of amalgamation, there is transfer of shares also, because one condition says that 75% of shareholding remain the same. So that means the shareholder of A Limited, because A Limited is going to cease to exist. It's going to be wind up. It's going to be finished. So the shareholder of A Limited will get the shares of now B Limited, because B Limited is purchasing this A Limited. So the shareholder of the shareholders of A Limited. Earlier they were having the shares of A Limited company, but now because A Limited is going to be amalgamated into B Limited, so A Limited is going to be ceased to exit. So in this case, now the B Limited will provide shares of B Limited in exchange of shares of A Limited. So there is exchange of shares also involved in the scheme of amalgamation. So technically, asset transfer is the one condition that is exempted, and one is share transfer, and that is technically exchange, because the shareholders of A Limited will now get the shares of B Limited in exchange of shares of A Limited. Whatever should be the ratio, that will be decided. Suppose it's 2:1. Suppose Mr. A is a shareholder of A Limited having 1000 shares of A Limited. And now in the process of amalgamation, B Limited says that we will give one share of B Limited in exchange of 2 shares of A Limited. So in that case, now Mr. B, who was having 1000 shares of A Limited, now will get 500 shares of B Limited. So technically it's a kind of an exchange. An exchange is also part of the definition of transfer. The first point of definition of transfer says sale, exchange. So there is a capital asset because shares are capital asset, and there is a transfer also, but it has also been excluded from the definition of transfer. But there is more condition to satisfy to exempt this transfer. First is same condition, B Limited should be an Indian company. That is same condition. So that means if in the case of amalgamation, this share transfer need to be exempted, there is condition need to be fulfilled. The condition number 2 is the consideration. What Mr. A is getting from B Limited in exchange of its share, the consideration should be in share only. That means you cannot pay cash or any other mode. You have to, in exchange, just give shares of B Limited. If B Limited says that we will give 400 shares of B Limited and balance 400 shares, we will pay cash. So that is not going to be exempted. That is going to be taxable. So if the exchange of share need to be exempted, then the amalgamated company should be an Indian company, and consideration in exchange of shares only will be in shares. There will be no other consideration mode. But the second point has an exception also. It has an exception which says in case of fraction of shares, we can the amount. What is the meaning of fraction of shares? Suppose the ratio is not 2:1, it has been decided 3:1. So now for against 1000 shares of A Limited, Mr. A will get 333.33 shares of B Limited. So now for this part, which is not fraction, the shares will be allotted. But fraction part cannot be allotted in the share form. So that can be paid in the form of cash, etc. So in case of fraction of shares, we can pay that fraction part only that fraction part in cash, etc. But the part which is not fraction, that should be paid always in cash, in exchange of shares only. Okay. So these are the condition. That is point number 4 wants to explain any transfer by the shareholder in the scheme of amalgamation of the shares held by him in the amalgamating company, provided amalgamated company is an Indian company, and the second condition is new, which is not in point number 3. Transfer is made in consideration of allotment of shares in the amalgamated company. No part of consideration will be other than shares, but consideration other than share is allowed only in case of fraction of shares. So amalgamation having two implication, one regarding the capital asset transfer during the amalgamation, that is exempted transfer if the amalgamated company is an Indian company. And the second case, it says the share exchange during amalgamation is also exempted for shareholder. Point number 3 is giving exemption to the amalgamating company, A Limited. And point number 4 is giving the exemption to the respective shareholder if the amalgamated company is an Indian company and only shares will be provided in exchange of shares, except in case of fraction of shares. Example, M held 2,000 shares in a company ABC Limited. This company amalgamated with another company during the previous year ending on 24. Under the scheme of amalgamation, M was allotted 1,000 shares in the new company. The market value of shares allotted is higher by 50,000 than the value of holding in the ABC Limited. The assessing officer proposed to treat the transaction as an exchange and to tax 50,000 as capital gain. Is he justified? So we will say he is not justified, provided two conditions should be fulfilled, that the amalgamated company should be an Indian company and there will be no consideration other than shares. Clear? Here's the answer. In the above example, assuming that the amalgamated company is an Indian company and shares has been transferred, then the assessing officer is not justified. Okay. Now, before taking up the point number 5, let me take some queries. Miss Lavanya is asking something. Sir, you said we will discuss on the problem of salary, page number 3.122, question number 5. Sir, just the scale part, how we take the salary for calculation. Lavanya, I have also discussed this scale part also. I guess in the last session of salary, I have discussed that part also. That for if the salary has been given in the scale mode, I've explained it, you might miss that lecture. But if you're asking, just for the time being, I'm telling you. If the salary is given like this, 550,000 dash 10,000 dash 80,000. It has been given, suppose on funds 10/2022. So if salary has been given in this way, that means salary on 1/10/2022 is 50,000 per month. And after every year, it will increase by 10,000. So that means from 1/10/2023, it will be 60,000 per month. After 1 year, it will be 70,000 per month, till it becomes 80,000. So if it is 25, it will be 80,000. Then there will be no increment. I have discussed this problem in, I guess, an illustration or somewhere else. You might miss that class, so kindly watch that class. Even if there will be any problem, I will make a note in detail for that and I will upload it. You can ask me in the next class, okay? And I guess you should not ask the problem regarding salary or house property now, because it has been a long time and we are discussing capital gain, but still I've discussed this topic, I remember. Next is, yes, Swati is asking, sir, is this the case of amalgamation in the nature of merger? Yes, there are two cases like amalgamation in the nature of purchase and amalgamation in the nature of merger. But under income tax, that is an accounting. Under income tax, we consider only amalgamation in the nature of merger also. Only merger only. Fine. We do not know the amalgamation in the nature of purchase because technically that is not amalgamation for the purpose of income tax. Next is Rahul Jain, 75%, 90% criteria is in the case of merger, but if amalgamation in the nature of purchase, then there is no such condition. I just explained. There is no concept of amalgamation in the nature of purchase under income tax. We only know one kind of amalgamation, which is amalgamation in the nature of merger. Fine. Next is Santosh Das, sir, how to secure password in computer and phone. Mr. Santosh, I guess you are quite mature person. You are not a age of 24, 25. I believe you are more than that. And I believe that we should not ask these kind of questions. I personally request to you. We are taking class of capital gain. We are not making fun of anything, or we are not discussing any other thing. We are technically discussing the provision of income tax. That's a very serious chapter, or we can say very serious subject and very important also. When you ask these kind of question that, sir, how we will do this, how we will lock our password, you really think you are wasting your time also? You are wasting my time also, and you are actually wasting a lot of students who are watching this class. So please be responsible. Please do not ask these kind of question. I request you, okay? These are not related to our topic. Kindly consider it as a request. Next is, so sir, what if the amalgamation in the nature of purchase that will not be exempted, that is going to be taxable, assuming that there is no amalgamation. That will be considered as a purchase, etc. Next is Neha Saxena is asking, sir, if any assessee donate it's some percentage of income, then it is a transfer or not? Money is not a donate, that's a donation. That is not a capital asset. So that is not going to be fall under the capital gain chapter. Fine, that will be under income from other source concept. Next, point number 5. Like we discussed the provision of amalgamation, almost in the same manner, there's also a new concept, point number 5, exempted transfer. It says transfer of a capital asset by holding company to subsidiary company or vice versa. Provided transferee company is an Indian company and holding company holds entire share capital. This is very important word, entire share capital of subsidiary company. We know the meaning of holding in subsidiary, fine. So now it says that if it happens, suppose there is one company which is H Limited and one is S Limited. Fine. This is subsidiary. This is our holding company. So it says if any asset has been transferred from holding to subsidiary or subsidiary to holding, both way allowed, fine. So if anything transfer between a holding and subsidiary company, then it will also be treated as exempted transfer if two conditions are fulfilled. Condition number 1, transferee. Transferee company should be Indian company. That means if asset has been transferred from holding to subsidiary, in that case, subsidiary is transferee company. So for this case, this should be Indian company. But if asset has been transferred from subsidiary to holding, that means in this case, holding should be an Indian company. So which company has been a transferee company should be an Indian company. Condition number 1. Condition 2 says entire share capital should be held by the holding company. Entire share capital. Entire share capital means 100%. Generally, we become a subsidiary if somebody holds 51% or more of our share capital. But for the purpose of this exemption, Now the entire share capital of S Limited should be held by the H Limited for the benefit of this. So we are not saying that to become a subsidiary, we need 100% share capital. No, it says only those holding in subsidiary asset transfer is exempted, in which holding holds 100% share capital of subsidiary company. And when we say 100% share capital, that means we are talking about equity as well as preference. So everything should be held by H Limited. Full capital of S Limited should be held by the H Limited. So if this kind of holding subsidiary relation exists, then there shall be exempted transfer if any asset has been transferred from H Limited to S Limited or S Limited to H Limited, provided these are Indian company. Clear? So because if 100% entire capital held by H Limited, then income tax says we do not bother about this transfer. So that is exempted transfer. Next is any transfer of a capital asset being any work of art or archaeological or scientific or art collection, book, manuscript, drawing, painting, photograph, print to the government, university, National Museum, National Art Gallery, or any other public museum as notified by the central government. So if you have any antique thing, and if you want to transfer this antique thing, work of archaeological collection, scientific art, etc., to government or any government museum, etc., then it will be a exempted transfer. Next is any transfer of FCCB. FCCB means foreign currency convertible bonds. Do you know the meaning of convertible bond? So those bonds which will be converted in future into shares, that is called convertible bonds. Clear? So if I issue any convertible bond in India, which will be converted into shares, or there will be option to convert them into shares in future date, that will call normal convertible bonds. So if I issue these kind of convertible bond outside India in any other country, so that need to be in that foreign currency. So that is called foreign currency convertible bond. So technically foreign currency convertible bond is nothing. If you are issuing convertible bond outside India in foreign currency of that country, that will be called foreign currency convertible bond. Okay. Again, ADR, GDR. ADR is American Depository Receipt and GDR is Global Depository Receipt. That is American Depository Receipt and this is Global Depository Receipt. What is ADR, GDR? Very simple. If I want to issue equity shares, if I want to issue or I issue equity shares in India, what it will be called? It will be called like an IPO or FPO, initial public offer, further public offer, or we can say normal equity shares. So they are technically equity shares. If we are issuing equity share in India, it will be part of FPO or IPO, etc. So if we issue equity shares outside India in America, so that will be called ADR. I'm just explaining you it in a very simple layman language. Technically, it's a different thing, but I'm just trying to explain you in a very simple language. So if you are issuing equity shares outside India in America, it will be called American Depository Receipt. And if other than America, then it will be called Global Depository Receipt. But there is a important thing. It is not like this that we are issuing equity share outside India. So if any company wants to issue equity shares outside India, then whatever equity share they will issue, that will be remain in India. Against these equity shares, we issue DR, that is called depository receipt. So equity share will remain in the India, but against that equity shares, there will be one instrument which is called DR, depository receipt. That is going to be issued outside India against the equity share which are in India. So if these DR has been issued outside India in America, it will be ADR. If any other place, it will be GDR. The difference between the ADR, GDR and equity shares is only one. ADR is having same characteristics as normal equity share, but ADR, GDR do not have voting rights. So voting right will not be transferred, only economic benefit like bonus share, dividend, etc. will be transferred to the person who is going to buy these ADR and GDR. So if you want to understand the concept of FCCB, ADR, GDR in detail, so you can Google it, of course, or you can refer any book. But for time being, for the purpose of income tax, I'm just explaining you, if there is any security which has been issued outside India and the buyer is a non-resident. So Mr. A, who was in USA, purchased ADR, which has been issued by an Indian company in USA. So suppose Mr. A, who was in USA, purchased those ADR from that Indian company, and after some time transferring that ADR to Mr. B in USA. So if any FCCB, ADR, GDR, we call it Euro issue. As we call equity share issue IPO, FPO, we generally call it Euro issue or rupee denomination bond. There's one more asset, the name suggests rupee denomination bond. So you can also issue bond outside India in rupees also, made outside India by a non-resident to another non-resident. The provision is this: if there is any ADR, GDR, FCCB, rupee denomination bond has been purchased by a non-resident, and now that non-resident is transferring that bond, ADR, GDR to another non-resident outside India. So that will be exempted capital gain, like this. Suppose there is an ABC Limited in India. It issues FCCB, ADR, GDR, rupee denomination bond in USA, etc. Mr. X of USA purchase these FDR, and now after 1 year, 2 years, 6 months, etc. Now Mr. X is transferring his ADR, GDR, etc. to Mr. Y. He is also in USA. They both are non-resident. So any of these asset has been transferred by a non-resident to another non-resident, and that is also outside India. This transaction is taking place outside India. That will be exempted transfer. Even the security belongs to an Indian company, still it will be exempted capital gain. Clear? Next is any transfer of capital asset by a demerger company to resulting company. So point number 8 and 9 in exactly the copy paste of point number 3 and 4. So as the same provision was in case of amalgamation, that if any asset has been transferred during amalgamation, the same provision has been copy paste in point number 8. So point number 3 is exactly as point number 8. And point number 4 talks about if any shareholder is transferring its shares to in case of exchange during the amalgamation, that is also exempted. So point number 9 is exactly the copy paste of point number 4. So 3 and 4 is exactly same, 8 and 9. That was in case of amalgamation, and this is the case of now demerger. Let me explain in short the meaning of demerger, so you will be able to understand these provision more clearly. Now, what is demerger? Suppose there is a company that is MWZ Limited, suppose, clear? And this Indian company having different kind of business. One is telecommunication. One line they are operating tech business. 4 department, pharmaceutical, petrochemical. So technically, this company's undertaking 4 kind of business activity. One is telecommunication, one is textile, one is pharmaceuticals, and one is petrochemical. And this is the result. This division, this telecommunication business is earning 80 lakh rupees profit. This textile division is in loss of 40 lakh. This is also in loss of 30 lakh. This is also in loss of 20 lakh. So company having 4 division, and this is the result of 4 division individually. In aggregate, if you will see, so there will be a loss of 10 lakh. So as a company, if we'll see that MWZ Limited having 10 lakh rupees loss. So what will be technically the picture in the eyes of the shareholder? Because there is loss, there is no profit. So the shares of this company, market price of this share of company will go down. Again, because it's a loss-making company. So even if they want loan from bank, etc., that is not going to be easily available because it's a loss-making company. Again, if they need capital, and if they think about new issue of shares in the market, so again, there will be much difficulty to get this capital because it's a loss-making company. But practically, if you'll see it from the eyes of a chartered accountant, if you try to see this, that is not exactly the loss-making company. It is a company in which, if as a chartered accountant, we need to explain this company. So might be somebody saying it's a loss-making company, but as a CA, we'll see this. Then we cannot pass this statement. We can see that it's not a loss-making company. It is a company in which one division is in huge profit. Huge profit, 80 lakh. But the other 3 division loss technically overcome the profit. So it is showing that it's a loss-making company. So as a CA, we cannot just give our judgment regarding the loss or profit. We need to explain the thing and we should understand the thing. So company is not bad. 3 divisions are not performing well, and due to the bad performance of these 3 divisions, the huge profitable division is also showing technically a loss. So in these kind of condition, to overcome this kind of condition, company generally can take this step also. They decided that we will separate this division from this company. We will separate this division. Because the loss of all these 3 companies showing a loss. So might be due to this problem, due to these problems, this division also start making loss. So that will be very bad for a company, because 3 division loss will result also the 4th division also will fall in the loss. So in this case, we can do this thing, that we can separate this division and make a new company. Might be named as MWZ Telecommunication Limited, whatever it is. So we are now transferring this division to create a new separate company. So at least this division will survive. If we'll separate this division with 80 lakh of profit and issue separate share of this company, then that means the share price of this division or this company will go high because profit is huge. Banks, etc., will ready to give it loan because it's a profit-making company. If they'll issue new share in the market, IPO, FPO, then there will be shareholder ready to purchase it because this is a profit-making company. So this process of separating one or more division from a company to form a new company, that is called demerger. And you can see it is opposite of merger. Merger means amalgamation. In amalgamation, if A Limited and B Limited, so A Limited is going into B Limited. So technically that is called merger. There is merging. But in this process demerger, we are getting separated. We are not getting consolidated. We are getting separated. So it's a reverse name of merger. We called it demerger. Under amalgamation, that means in merger, there is always reduction in the number of companies, because there were two companies, now there is only A Limited will cease to exist, there will be only B company, one. So there is number of companies cease to exist always. But in case of demerger, number of company will increase because we are just demerging, we are making extra division. So this process is called demerger. In this, MWN will be called demerged company. The new company will be called resulting company. Process will be called demerger, and all the condition is almost same as in case of amalgamation. All the asset of this division only, all the asset of this division will be transferred to this company. So the division of demerged company asset should be transferred to the resulting company. All the liabilities again should be transferred from the demerged company of that division to the resulting company. This should be on book value, same. So technically, the full balance sheet of telecommunication department should be transferred to the new MWZ Telecommunication Limited. In the same condition again, third, 75% shareholding remain the same. So the transfer of asset during this process of demerger, transferring the asset during this process, demerger, will be exempted transfer. Same in case of amalgamation, if these conditions have been fulfilled. And the condition is the new company should be an Indian company. So these condition is for demerger purpose. For the income tax, it says in the process of demerger, all asset transferred from the demerged company to the resulting company will be exempted transfer if resulting company, that is new company, should be an Indian company. Again, the same case, share will be exchanged because now the new shares will be MWZ Telecommunication Limited will be provided to the shareholder of MWZ Limited. So now these old shareholder will get the new share of this company. That is kind of an exchange. Same concept of amalgamation is applicable. Exchange of share will also exempted if the transferee company, that means resulting company, must be an Indian company, and shares will be transferred against consideration against share. There will be no other mode of consideration except in case of fraction of shares. So that was the definition of demerger. So we have understood the meaning of demerger, we understood the meaning of demerged company, we understood the meaning of resulting company, and the provisions are exactly same as in case of amalgamation. You can see that. Any transfer of capital asset, why I explained you the meaning of demerger concept, why? With the help of an example, why I explained that? Because if I'll not explain that, then how you will understand that why it's exempted? How you will understand what is the meaning of resulting company? How you will understand the meaning of demerged company? So now it will be easy for you to understand the concept properly. Transfer of capital asset by a demerger company, that should be demerged company, right? It's a demerged company. To resulting company during demerger is exempt provided resulting company is an Indian company. Same provision, exactly same for share case. Any transfer or issue of share by the resulting company to the shareholders of the demerged company if the transfer of issue is made in consideration of demerger of the undertaking. The consideration should be in share only, and fraction concept is also same copy paste, exactly as same in case of amalgamation. Okay. Now 10th is any transfer of capital asset being a government security by one non-resident to another non-resident outside India. It is same as point number 7. That was for FCCB, ADR, GDR. That is issued by private company. So even if any government security is issued by government outside India, and it has been transferred by a non-resident to another non-resident outside India, that is exempted capital gain. Any redemption of sovereign gold bonds under the government scheme by an individual will be exempted. This is new point number 12, which has been inserted. Conversion of gold into electronic gold receipt or vice versa. Any transfer of a capital asset being conversion of gold into electronic gold receipt issued by a vault manager or conversion of electronic gold receipt into gold. Section 47(7)(d). There's no capital gain on conversion and reconversion. Clear? So we have discussed these 12 points, and now the numerical part start regarding these 12 points. So technically, these above 12s are exempted capital gain. So if I'll ask you a question, that tell me, out of these 12 cases, in the examination, there will be numerical topic regarding these 12 points, or there will be more chances for a theoretical topic in above these 12 points. Listen my question carefully. If I ask you that in the above 12 points, there will be more chances to ask as a numerical question in regarding this exempted capital gain cases, or there could be more chances to ask a theoretical question regarding these above 12 cases. Can you tell me it should be numerical, more chances, or there will be chances for theoretical question? Think about it. Till then, let me take the queries. Jay Patel is asking, sir, we have to write provision in practical sum also? No, generally you do not need to write provision in the numerical provisions. If there is a capital gain question, we need to solve it. Whether it's a long term or short term, we need not to write that these are long term asset, these are short term. If you are finding it is a short term asset, you can directly write it down. It's a short term capital asset or it's a long term capital asset. Okay. Provision should be there when you believe that that should be explained in the numerical, that why you are doing something. In that scenario, you can or you should write the provision. You can see the study material illustration, the way they solve it, the numerical part, in the format. The no provisions are there. They explain the provision is a working note, and that is for to make you understand how they calculate the things. Okay. Next question is Mrs. Nancy Saxena. Sir, my name is not Neha, it's Nancy. Okay, Mrs. Nancy, I apologize, sorry. Next is Parth Rana. Sir, in this transferring of capital asset either by holding or subsidiary to whom it is transferred, that must be an Indian company? Yes, correct. So the company which is receiving the asset, the transferee company, should be the Indian company. Next is point number 5 is relatable to full acquisition. No, we are just discussing, who is asking it? Swati. We are just discussing point number 5, that if there is any holding in subsidiary already exist, in which holding holds 100% share capital of subsidiary. Clear? If in these kind of undertaking, any asset has been transferred, whether it's land, building, machine, any kind of asset, then that will be exempted transfer. Okay. Mr. Sushil Kumar Barik, I explained the full form FCCB, foreign currency convertible bond, ADR is American depository receipt, and GDR is global depository receipt. Okay. Mr. Avinash is saying, sir, can you please explain point number 7 in Hindi? 7 in Hindi. अच्छा ठीक है मिस्टर अविनाश, 7 in हिंदी. पॉइंट नंबर 7 ये कहता है हिंदी में कि अगर आपके पास कोई एफसीसीबी है, अब एफसीसीबी की हिंदी मुझे नहीं पता, एफसीसी का मतलब ऐसे बॉन्ड्स जिन्हें आप फ्यूचर में शेयर्स में कन्वर्ट करने का ऑप्शन होता है, जिन्हें आप फ्यूचर में कन्वर्ट कर सकते हैं शेयर में, उन्हें हम कन्वर्टेबल बॉन्ड्स कहते हैं. ADR है अमेरिकन डिपॉजिटरी रिसिट, GDR है ग्लोबल डिपॉजिटरी रिसिट, और रुपी डिनोमिनेशन बॉन्ड। सिंपल लैंग्वेज में अगर अविनाश मैं आपको बोलूं तो FCCB, ADR, GDR और रुपी डिनोमिनेशन बॉन्ड ऐसी सिक्योरिटीज हैं, ऐसे शेयर्स और अदर सिक्योरिटीज बॉन्ड्स हैं जिन्हें कोई इंडियन कंपनी इंडिया के बाहर इश्यू करती है, इंडिया के बाहर, आउटसाइड इंडिया, अमेरिका में या कहीं भी, ठीक है। तो वहां जो पर्सन उसे खरीदता है, मान लीजिए मैं एक इंडियन कंपनी हूं, मैंने अपने बॉन्ड्स अमेरिका में इश्यू कर दिए और वहां मिस्टर रिकी पॉन्टिंग ने वो खरीद लिए, ठीक है। अब रिकी पॉन्टिंग ने वहां खरीदने के 1 साल बाद वो बॉन्ड्स और ADR और GDR और रुपी डिनोमिनेशन वो वहां पर मान लीजिए एक दूसरे नॉन रेजिडेंट, मान लीजिए ब्रेटली को बेच दिए। तो उन दोनों के बीच में जो सेल परचेज ट्रांसफर हुआ, कैपिटल एसेट है, क्योंकि सिक्योरिटी कैपिटल एसेट है, तो उस पर कोई कैपिटल गेन नहीं लगेगा, बिकॉज हमारी गवर्नमेंट ने उसे एग्जेम्प्ट करा है कि खरीदने वाला और बेचने वाला अगर दोनों नॉन रेजिडेंट है, दोनों आउटसाइड इंडिया है और ट्रांजेक्शन भी कहां हो रही है, आउटसाइड इंडिया, उस पर कैपिटल गेन चार्ज नहीं होगा। यही पॉइंट नंबर 7 कहता है, यही पॉइंट नंबर 10 भी कहता है। क्लियर? नेक्स्ट इज Mrs. Suman Goel is asking, sir, I beg you pardon to ask a question. Okay. Purchase price of capital asset held before 1/4/2001 is higher of FMV at 1/4/2001, or purchase price whichever, or purchase consideration is actual price paid at a purchase time which might be very low. But what is the question in this, Mrs. Suman Goyal? You didn't ask me anything. मैं explain कर देता हूँ simple language में. If any asset has been purchased before 1/4/2001, except in case of goodwill of business or profession, etc., because in that cases there is always purchase price considered, whether it's before 1/4/2001 or after. Except that goodwill of business and profession case, if any asset has been purchased before 1/4/2001, then whatever the purchase price, that purchase price means whatever has been paid by you for that asset, that is purchase price. That price need to be compared as on purchase, as on FMV on 1/4/2001. Whichever higher will be your cost of acquisition. Purchase consideration means actual purchase price you have paid. So whenever we say purchase price or purchase consideration, that means the payment we have made for the purchase of that asset in actual. FMV can be lower or higher, but the purchase price will be the price which has been paid by us. Next is Parthrana, you got the concept of demerger. Thank you so much. You are saying, okay, you're most welcome. That's why we are here to help you. Kokarna is saying, Koki Nati Balamurali Krishna. Beautiful explanation of demerger, sir. Thank you so much. Ruturaj is saying, sir, I'm not seeing the ADR, GDR point in my study materials. So is there any amendment regarding the same? You should refer the study material. There is any foreign security also. That means ADR, GDR, etc. Next is okay. So I asked you that regarding these 12 points, there is chances to ask a more theoretical question or numerical. So Avinash saying theory, Kadambari saying numerical, theory, numerical, more chance theory, theory, numerical, numerical. But the correct answer it, in my opinion, there is more chance of numerical. And I believe 80% chance that these 12 points should be asked as a numerical question. Why? Because now here comes the special provision regarding these above 12 points. What it is, I will tell you. Okay. Harsh is asking, sir, please explain 11 point again. 11 point is just the government issued some sovereign gold bonds, and if these have been transferred, there will be no capital gain. Sorted. Here, non-resident means NRI, non-resident means NR. So it can be a NRI or not, it depends, because if it is a non-resident status, NRI is different. But for the purpose of this, if you are a non-resident, then this condition will be applicable. Yes, NRI includes NR in this point. But technically, they both are different, NRI and NR. That you must have gone through with the provisions of residential status, I guess chapter number 2. Hemlata, please explain meaning of vault manager. Now, this has been inserted by the department recently, and it's a scheme started by the government regarding this vault manager and gold receipt. You can Google it for the meaning, because if we'll start explaining the meaning of these kind of things, that will take a lot of time. Fine. So you should go to the Google and understand the meaning of vault manager, the scheme started by the government, etc. Sushil, sir, point number 4, discuss please. Point number 4 was regarding amalgamation. You can scroll back the video. I have explained that in details, Sushil. Kindly watch that. Okay. So now we are moving to the main provision. In the starting, we discussed that technically the capital gain chapter is very easy. Because what we need to solve a numerical, we need sale consideration that will be given in question. We need cost of acquisition that we know how to calculate. And we need to know the indexation concept that we have discussed. And that cost of improvement, etc. So that is sorted like that is very simple format. It's a simple format. But there is some special cases also. So the above 12 cases, what we discussed, so it generally feels that it will be a theoretical question because these are exempted capital gain. So if these are exempted capital gain, then why we need to calculate it a numerical topic? Because here is a reason. The numerical will be framed like this, that suppose there is Mr. A. Let me explain in the separate sheet. In all these above 12 cases, there are similar provision to solve it. Similar provision. It says, suppose there is Mr. A who purchased any asset, suppose on 1st November 2004, and give this asset to his son on 1st July 2009. At the time of gift, the FMV of this asset was 20 lakh. Mr. A purchased this asset for 12 lakh. Now, son has sold this asset on 1st October 2023 to Mr. C for rupees 60 lakh. The cost of improvement done by Mr. A on 1st July 2006 for rupees 1 lakh. The cost of improvement done by the son on 1st October 2014 rupees 2 lakh. So it has been sold to Mr. C. And now the examiner will ask, calculate the capital gain in this situation. So because Mr. A gifted this property to his son, so there will be no capital gain because that is exempted under section 47, all gifts. So there is no need to calculate any capital gain in this year when they transfer asset. That means assessment year 10-11. There is no requirement to calculate any capital gain. So this is our theoretical point. And it says when you gift any asset to anyone, That is exempted capital gain. So why it will be a numerical question? Because in the examination, it will not stop over here. The end will not be over here. The examiner will say you that this asset has been transferred in future to Mr. C. So now for this assessment year, we need to calculate the capital gain. So how we need to calculate the capital gain? There will be some new cases arise. There will be new situation arise. So we need to listen very careful, be focused, because that is very important question for the purpose of examination. And out of all these 12 points, the solution is almost same in every case, whether it's gift, whether it's amalgamation, whether it's partition of HUF. You can change any scenario over here, but the solution will remain the same. So for the purpose of calculation of capital gain, first of all, we will write like this: calculation of, always follow this format in capital gain in every question. Calculation of capital gain in the hands of assessee. Who is the assessee in this case? Who is going to pay tax? That is the son. Fine. Suppose the son name is B. So in the hands of Mr. B for assessment year 24-25. Clear? Now the first thing we need to calculate for the purpose of capital gain is period of holding. Now the new concept says, if any asset has been received by the assessee by way of gift, will, partition, amalgamation, demerger, whatever cases these are, those means if any asset has been received by assessee via those 12 cases, via those transfer, those are exempted under section 47. So the time period of previous owner, Mr. A will be called previous owner. Mr. B will be assessee. And C is the buyer. So the provision says that if any asset has been received by the assessee via those 12 cases, in that situation, the period of holding will not be from the assessee time duration. The period of holding will be started from the previous owner. So the period of holding will be start from previous owner till the real buyer. So that means period of holding include the time period which has been held by Mr. A also. So in normal case, if that is not a gift case, it's a normal case, then we take the time period from 2009 till 2023. But if the asset has been received via any mode which has been explained in above cases, then the period of holding of previous owner will also consider. That means period of holding will start from 2004 till 2023. So that will be a long-term capital asset. So we are calculating tax for Mr. B, who is an assessee, but for the period, for the purpose of time period, we have to take the previous owner time period also. So that's why it's a important provision. That is special provision that is different from normal provision. So if any asset has been received via gift, will, etc., then the time duration of that person also included for the purpose of period of holding. Clear? Now the sale consideration. So no issue in sale consideration, that has been given in question, 60 lakh. Now let's index cost of acquisition. Why we are doing indexation? Because that is a long-term capital asset. Suppose it's a building. Clear? So now for the purpose of index cost of acquisition, we should take first of all cost of acquisition. Again, what is the cost of acquisition in the hands of Mr. B? This SPMV is irrelevant. Cost of acquisition means, is anything has been paid by Mr. B, the son? No, he received that asset for free. But a special provisions are there. So technically we should write 0 because assessee did not pay anything for it. But here is a special provision comes and it says, in case of those 12 cases, the cost of acquisition of assessee will not consider the cost of acquisition of previous owner we need to take. Who is the previous owner? A. So time period of previous owner will take from A till now. And again, the cost of acquisition also will be considered from the point of view of Mr. A, because Mr. B do not have any cost of acquisition. It's a good provision for you. If we will take the cost of acquisition of B, so that will be 0. And if the cost will be 0, then index cost will also be 0. That means full sale consideration will be your gain. And that is going to be taxed completely. So that is a beneficial provision has been made for you, that in these 12 cases, if the assessee get the asset out of these 12 case asset, in these 12 cases in which he did not pay anything, so in that case, the cost of previous owner will be taken. Don't worry, after the example, I will make short note for the solution. It's a very simple provision to solve it. I will explain how you can solve it. Like this. In these kind of question, there is a formula, that is period of holding kiski leni hai? Previous owner. Period of holding will be taken from previous owner. Cost acquisition, previous owner. Sorted. So now cost of acquisition of previous owner was 12 lakh. So we will take cost acquisition 12 lakh multiplied by year of transfer. So year of transfer is this. Of course, that means 348 is the index for the year of transfer. But now what the formula says that the index for the purpose of division will be taken. The formula says the year in which asset is first held by assessee. So we are taking period of holding from the point of view of Mr. A, who is the previous owner. You can see that. We are taking cost of acquisition from the point of view of Mr. A. You can see that. So for the purpose of division, we should take the index of also previous owner. As per the logic says that if we are taking time period from the point of view of Mr. A, if we are taking the cost of acquisition from the point of view of Mr. A, even he is not an assessee, assessee is B, but we are taking all these things from the point of view of Mr. A, then the index for the purpose of division should also be from the point of view of Mr. A. But there is a problem. If you see the formula of indexation, the formula says cost of acquisition multiplied by the transfer year index, which is 348. And the division part says index for the year asset held by assessee. So that is not the previous owner as per the formula. And who is the assessee? Assessee is Mr. B. So the problem is this, that for the purpose of index, we need to take the assessee index, and that is Mr. B. So when he got the asset, he received that asset on July 2009. So we need the financial year 2009-10 index. So in the division part, we will find the 9-10 index, whatever it will, we will write it over here. For time being, I am writing the year only. So that will be given in question, 9-10 index, we have to write it over here. And why we are doing so? You can see we are taking period of holding from the point of view of Mr. A. We are taking cost from the point of view Mr. A. In my opinion, the index should be also from Mr. A. That should be 2004 and 5. But as the formula, as the act suggests, the act says that the index for the year asset held by assessee, we need to take that. So for that, we have to take the index of Mr. B. So that is a loss for us, because the division of 9-10 value will be higher in comparison to this. So if the 2004 and 5 index value will be taken over here, then the index cost acquisition will be higher. Just wait. Then cost of improvement need to be deducted, and cost of improvement of previous owner as well as the assessee both need to be deducted. And the formula is simple: cost of improvement multiplied by 348 it does not have any connection with the previous one or assessee. The division part of cost of acquisition formula, cost of improvement formula says in the year improvement took place. So this year improvement took place. That means we will take the index of 2006 and 7 that will be given in question. And this third case is 2 lakh into 348 upon the index of 2014-15. So we need to deduct these three as cost acquisition index and index cost of improvement, and that will be my long-term capital gain or loss as the case may be after the solution. But this has been opposed by many assessee. They have said this is wrong. Only on this point there was dispute. Only on this point, this index point, for the purpose of index cost of acquisition. Act says we are taking period of holding from the point of view of Mr. A. We will take the cost from the point of view Mr. A, who is the previous owner. Okay. So assessee says this is wrong. So if the cost is from the point of view of Mr. A, if the period of holding is from the point of view of Mr. A, then why the index has been taken from the point of Mr. B? So the act says because it has been written in the formula, so some assessee went to the higher authority and they won. And we have a judgment in the case of CIT versus Manjula J. Shah. That has been written in the notes also. In this judgment, department accept the view of assessee and it says yes, the index cost of acquisition should be taken from the point of view of Mr. A. So act says it should be from the point of view of Mr. B. But for the purpose of that case law, the judgment has been given that the index should be from the point of view of Mr. A only. And A purchased that asset in 2004. So the index for the purpose of improvement should be taken of 2004 and 5. Another point number 2 and 3 will remain the same because this is nothing disputable for dispute for the purpose of period of holding. For the purpose of cost, only the dispute was regarding this, and that is genuine also. So if we are taking everything from the point of view of Mr. A, then why we are taking index of Mr. B for the purpose of indexation? That was happening because of the formula says so. So in the case of judgment, the department understood the intention of assessee and they allowed that yes, you will use the index of Mr. A. But this is as per CIT versus Manjula J. Shah. Now the problem started. This has not been amended in the act yet. It has not been amended in the act yet. So in the act, it has been written that the index will be taken as per the assessee. But because the judgment has been in the favor of this, so an assessee can take the benefit of this. By referring this case law, you can take the advantage of this. And you can see if you solve with this method, your capital gain will be lower than the above case. So what we should do in the examination, why act has not been amended? Because it is not a judgment of Supreme Court, etc. It is just a CIT judgment. So the problem arises that what we should, how we need to solve it, this question in the examination. And now listen carefully how we need to solve it. We need to solve this question both ways. As per act, as per Manjula J. Shah. So if in question it has been said that you have to solve it with Manjula J. Shah or you have to solve it with only as per the provision in act, then we will solve it as per the question says. But if the question is silent or the question says nothing, then we have to solve it by both ways. And do not bother because you might be thinking that, oh my God, the calculation will be so difficult, so huge now. No, everything, nothing will change. Once you solve it like this, as per normal case, and in the similar, you have to solve it like this, as per Manjula J. Shah, sale consideration will remain the same. Index cost of acquisition only just need made one change. This should be 2004-5 index. The cost of improvement index, everything will be same. Only this point need to change. Only one value just need to change. That's it. So it will take not more than 1 or 2 minutes if you are going to solve it with the help of a Manjula J. Shah. So do not think that you have to calculate a lot of things. Everything will remain the same. The period of holding, the sale consideration, the cost of improvement concept, just one value need to change. So your calculation part will be changed. It will take not more than 1 or 2 minutes in the examination. If you won't believe it, I will solve a question for you. Then you will understand how it works. So you understood why these 12 cases will form part in numerical. Because in numerical, there will be exempted capital gain, but in the question, they will also provide you that this asset has been sold later. And when it's sold later, then you have to apply these provisions. So this is very interesting provision, in my opinion. And these clarification exactly say the same. In all above cases, capital gain will be exempted as transaction will not regarded as transfer. But in above cases, when assessee will transfer these assets in normal case in future, in that year, capital gain will be liable to charge as follows. So that exempted transfer will affect you when you will sell that asset in future in a normal case. So that how it will affect you? The period of holding will be taken from the previous owner. The cost will be taken from the previous owner. The index for the purpose of division will be taken of the assessee once and again as the previous owner as per Manjula J. Shah. You have to write that case law if you need to solve that question as per this method. So you can see the picture must be seeing, that is previous owner Mr. A purchased in 2012 for rupees 10 lakh, any asset. This asset has been gifted to Mr. B in 2016. So assessee is Mr. B, that is current owner. So B has transferred this asset to Mr. C for 32 lakh in January 2024. So he is the buyer. So clarification says for Mr. B, capital gain period of holding will also include the period of holding of the previous owner. So we will consider the period of holding of previous owner also. That is from 2012 till 2023. Clear? The cost of acquisition will be of previous owner. So previous owner purchased this property for 10 lakh rupees. So the cost of acquisition will be taken as 10 lakh. Index for normal case, that is B assessee will be taken. Normal case means as per act. So as per act, we have to take the index for the purpose of assessee. Who is assessee? This is assessee, Mr. B. But in case of Manjula Shah, index for Mr. A will be considered, all other will be same. So as per Manjula J. Shah we talk, then we have to take the index of Mr. A. Do not worry, everything has been written. So cost of acquisition and period of holding for above cases as follows. I have wrote down in the simple language to make you understand these provision. In cases of the above transaction, cost of acquisition in the hands of transferee shall be the cost of acquisition in the hands of the previous owner. So for the purpose of assessee, the cost of acquisition need to be taken old cost of acquisition. Old cost of acquisition means previous owner. For the purpose of period of holding, old period of holding. That means previous owner. Index need to be taken assessee index, because as per act it has been said that index need to be taken as per the assessee. Other view, which is as per CIT versus Manjula J. Shah, Bombay High Court 2011. It has not been made by Supreme Court, so it has not amended into the act yet. So other view say old cost, of course, previous owner, old period of holding, and this is just change. The index should also be taken from the point of view of previous owner. So cost and period of holding always be taken from the point of view of previous owner. Only index need to be taken once as per assessee and need to be solved the question, and once it has to be taken from the point of view of previous owner. Where the cost for which the previous owner acquired the property cannot be ascertained, then the fair market value need to be taken. The cost of acquisition to the previous owner means the fair market value if the cost has not been given in the question or it is uncertain to calculate. Then the FMV at the time of purchase of that property by the previous owner need to be taken as cost of acquisition. 13th point is reverse mortgage. Now it's a very simple concept. Mortgage means to take loan against the security of any asset. That's called mortgage. So mortgage is a very simple word, that to avail any kind of loan or finance on the security of any asset or any building, etc. That's called mortgage. Reverse mortgage is the reverse of that concept. So we need to explain. I need to explain you first the basic meaning of mortgage, how it works, and then we'll move on to the meaning of reverse mortgage. Right? So before that, let me take some query. Then we will go for a break, and after the break, we will come back with a story for today and the remaining provision for today. Next is Nagarju, sir, what will be the cost of acquisition for the assessee in the nature of amalgamation and demerger? At the price at which that asset has been purchased. Same, there is nothing new. If I take shares in exchange in an amalgamation, I am a shareholder of A Limited company. A Limited is going to be merged with B Limited. So now I am getting shares of B Limited in exchange of A Limited. So that is an exempted capital gain. But in the future, when I will transfer the B Limited shares, then the purchase price of my A Limited shares, whatever it was, that is going to be the cost price for that. Next is, so cost of improvement by Sun. No, it will be included, Miss Vaishali Bindal. I guess you might ask this question before. Cost of acquisition will always included if it is on or before 1st April 2001. We have discussed in cost of acquisition, cost of improvement provision, that only those COI will be ignored which has been incurred before 1/4/2001. You might read this point. It has been written clearly regarding the cost of improvement. You can see that cost of improvement incurred before 1/4/2000 will be ignored, but cost of improvement done by assessee or previous owner. So this previous owner means this case what we just discussed. So any cost of improvement done by owner after 1/4/2001 need to be deducted. Next is, so index cost of acquisition and cost of acquisitions are same if different in which circumstances. Mr. Sushil, you might not watch the last lecture. That's why you are asking this question. This is our second session of capital gain. I've explained all this in the first session. Kindly go and watch the first class first. Then watch this class so your confusion will be clear. COI will be taken in all cases. In case of even Manjula J. Shah, COI will be taken. I've just explained you only one difference in Manjula J. Shah and the normal case. And that is the cost of acquisition index need to be changed. The cost of improvement will also need to be deducted even in case of Manjula J. Shah, same as per normal case. There is no difference regarding the. Look, in this case, even in this Manjula J. Shah, I explained it. Even in case of Manjula J. Shah, we need to take the cost of improvement same. There is no change in the cost of improvement. We need to take the cost of improvement of previous owner as well as assessee both. There is no change. Only the change is this. All other things will remain the same. Okay. Next is, what if the asset is an ancestral property passing from generation to generation as a gift? Because of that, we do not know the cost of the asset. If the asset has been an ancestor property, Mr. Gandhi Nagbala Murugan, then we do not know the exact purchase price. You are correct. But we, in that case, we took FMV on 1st April 2001. as your cost of acquisition. If any asset has been purchased before or received before 1/4/2001, then the FMV on 1/4/2001 will be taken as a cost of acquisition. And the previous owner index will be taken 100 because we do not have any index before 1/4/2001. It will be solved. Do not worry, I will solve a question like this. So that problem will be solved. In which year that case has been, I've explained to you, it has been 2011. You don't need the provision, High Court 2011. Okay. Next is Mr. Sankaran asking if in question both index are given, we can solve as per Manjula J. Shah. If not given in question paper, then working as per present law will be worked. Am I correct, sir? You might possible, but in the examination, both previous year index will be given as per the assessee purchase year and as per the previous owner. And in that situation, we have to solve it by both ways. Okay. Okay, Ms. Vaishali Bindal asked a different question. She's saying, sir, if asset has been given twice, it will remain the same. There is no problem. Suppose if there is Mr. A who purchased this asset for 10 lakh rupees in 2006, gifted to his son, Mr. B in 2010, son gifted to his son, Mr. C in 2015, C donated in 2017 to D, and now it has been sold in 2023 for 100 lakh. No problem. Now we will solve it. Period of holding will be taken always from the previous owner. He is the owner. Previous owner means who has actually paid. Those are exempted gains. That time duration will not be considered. We will consider from the time when somebody has paid. That not an exempted transfer. So period of holding will be from Mr. A, that is 2006 till 23. Sale consideration is 100. Index cost of acquisition, the cost of acquisition of Mr. A, 10 multiplied by 348. So as per Act, we need to take the assessee index. In this situation, Mr. C has donated Mr. D and D sold. So who is the assessee? Assessee is D. Because the person who is going to pay tax in real is Mr. D, because he has the asset, he got the money, so he needs to pay the tax. So once we need to take the index of 1718, that will be given in question and we need to solve it. As per Manjula J. Shah, when we will move, then sale consideration will 100, period of holding, etc. will remain the same. Then just the formula will change, that is 348, and index we will take from 2006 and 7. So it does not matter how many times it has been gifted, until otherwise it is exempted capital gain. Out of these 12 cases, it does not matter to us. We will solve it with the same process. Sale consideration, assessee of previous owner will be that person who has actually purchased that asset by giving some money. So those B, C or D who receiving this kind of asset via these 12 modes need to be ignored. We do not need to do anything except the index of the assessee. All information of 2010, 15 and 17 are irrelevant. Next is Nancy Saxena. Sir, interest on fixed money, jewelry in bank, it comes under capital gain? No. Interest will form part of income from other source. There is no capital asset. That's why it will not taxable under capital gain. Parth is saying, sir, what I am getting is cost of improvement are taken of both because there is cost increment in asset for both, and therefore it will be fair for assessee while deducting from net consideration. Yes, you are correct. Well done. Okay, so we discussed the provision regarding capital gain till now. Now we are going for a small break, and after the break, we will discuss the provision further. So, Mr. Manish, can we go for a break? Okay, welcome back everyone. I believe you must have your tea, coffee, water, etc. And we are back to our capital gain provisions. So there is no more query. So we were discussing the provision, this reverse mortgage scheme. So before that, let's have a small and short story, and that is really going to help you. This is a very real story, actually. And if any one of you know the name regarding whom this story is all about, that will be really appreciable. So stories like this, एक बहुत छोटा देश था और एक बहुत छोटा वहाँ पर एक गांव था, वहाँ पर एक छोटी बच्ची थी और वो अपना स्कूल में जाना उसे बहुत पसंद था, बट स्कूल गांव से थोड़ा दूर था। तो घर पे काम करती थी एंड देन भाग कर स्कूल जाती थी क्योंकि लेट हो जाती थी, और फिर वापस स्कूल से भागकर वापस घर आती थी बिकॉज घर पे भी काम करना होता था। जब स्कूल बड़े स्कूल में आए तो कॉलेज और दूर था उसके घर से, तो फिर उसको और भाग कर जाना पड़ता था और फिर वापस से भाग कर आना पड़ता था। तो इस तरह से वो अपना काम मैनेज करती थी। बट जब वो इस तरह से डेली भागती थी तो उसके स्कूल के टीचर थे, स्पोर्ट्स टीचर, बहुत छोटा सा काम था, तो उन्हें रियलाइज हुआ कि ये रनिंग में बहुत अच्छी है, तो इसको अगर रनिंग की प्रैक्टिस कराई जाए तो ये हमारी कंट्री को रिप्रेजेंट कर सकती है। तो उन्होंने उसको बोला कि तुम स्पोर्ट्स में जाओ और पढ़ाई के साथ स्पोर्ट्स पे भी ध्यान दो। और उस बच्ची को भागना पसंद था, तो उसने भी यही काम शुरू किया। स्पोर्ट्स स्कूल में भी करती थी, कॉलेज में भी, और फिर वो घर भी भाग कर ही जाती थी और भाग कर आती थी। तो धीरे धीरे शी इम्प्रूव्ड एंड वो जो मैराथन होती है उसके लिए उसने अपने कंट्री को रिप्रेजेंट करने के लिए क्वालिफाई किया। तो वो इतना बहुत टाइम पहले की बात है एक्चुअली, तो उस टाइम बहुत कम फीमेल्स होती थी जो रिप्रेजेंट करते थे अपनी कंट्री को। और वो अपने कंट्री की फर्स्ट पहली एथलीट थी जो मैराथन में जाने वाली थी एज अ फीमेल। तो जब अपनी कंट्री को रिप्रेजेंट करने वो मैराथन रेस के लिए गई तो उसका टाइमिंग अपनी कंट्री के हिसाब से काफी अच्छा था। लाइक सपोज 15 किलोमीटर की मैराथन एक्चुअली 42 किलोमीटर की होती है, बट फॉर द पर्पज स्टोरी इट 15 किलोमीटर मैराथन रेस थी। और उसका टाइम उसके हिसाब से लगभग 40 मिनट में वो 15 किलोमीटर का टाइम ड्यूरेशन कैच करती थी एंड शी वॉज वेरी गुड इन इट। बट जब रेस होने के लिए स्टेडियम में पहुंचे, जो फर्स्ट टाइम उसकी लाइफ का ये रेस था जब वो अपनी कंट्री से बाहर गई, तो शी वॉज वेरी नर्वस बिकॉज वहाँ बहुत बड़ी 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 कंट्रीज की बड़े बड़े रनर्स थे जो बहुत फेमस थे, जिसने उसने जिनके बारे में सुना था। और जब वो उन्हें लाइव देख रही थी तो शी वॉज थिंकिंग कि मैं कैसे यहाँ पर परफॉर्म कर पाऊंगी। बट रेस स्टार्ट हुई, शी स्टार्ट रनिंग। एंड उस टाइम में मैराथन होती ऐसी थी कि जब स्टेडियम से आप बाहर निकलते थे तो जो 10 रनर्स दौड़ रहे थे डिफरेंट डिफरेंट कंट्रीज के, तो जो उनके लाइंस थे जाने के रेस के ट्रैक वो डिफरेंट हुआ करते थे। तो लेंथ बराबर थी बट दे कैन नॉट सी ईच अदर, कौन हमारे साथ है, कौन पहले पहुंचेगा, कौन बाद में। वापस से स्टेडियम के बाहर आके वो सारी लाइंस मिलती थी। तो जब रेस स्टार्ट हुई स्टेडियम के बाहर जाके सब अलग अलग डायरेक्शन में गए। सो आप ये जज नहीं कर सकते कि कौन आपके साथ जा रहा है और कौन आपके पीछे है। तो वो दौड़ती रही और जब वो पार्ट आया जब वो वापस से एक रो में उनको आना था स्टेडियम के बाहर, तो उसको दिखा कि ना तो उसके आगे कोई था और ना कोई पीछे कोई था। तो शी वॉज थिंकिंग कि या तो मैं सबसे आगे हूँ या मैं सबसे पीछे हूँ। एंड तब उसने स्टेडियम में से आवाज सुनी कि वो स्टेडियम में से स्पीकर पे आवाज आ रही थी, जो जो कंट्री के रनर्स आ गए थे स्टेडियम में उनके नाम लिए जा रहे थे कंट्री के। और 10 में से सारी कंट्रीज के नाम ले लिए गए, बस उसकी कंट्री का नाम नहीं था। तो शी अंडरस्टूड दैट वो सबसे लास्ट है। And उसको बिलीव नहीं हो रहा था ये हुआ कैसे, बिकॉज शी गेव हर बेस्ट। शी स्टार्ट क्राइंग कि मेरी कंट्री वालों को कितना बुरा लगेगा कि मैं सबसे लास्ट आई, मतलब इतना बुरा मैं परफॉर्म करके यहाँ से जाऊंगी, सो इट विल बी रियली बैड फॉर मी। एंड शी विल स्टार्ट क्राइंग एंड शी मस्ट बी थिंकिंग कि मुझे अब दौड़ना ही नहीं चाहिए, आई शुड लीव दिस ट्रैक। बट शी डिसाइडेड नो, आई विल कंप्लीट माई रेस। एंड शी स्टार्ट रनिंग। स्टेडियम के अंदर एंटर हुई, उसने देखा दूर जहां फिनिश लाइन थी वहां पर सेरेमनी भी स्टार्ट हो गई थी। तो शी स्टार्ट मोर फीलिंग मोर बैड, ये कितना 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 बुरा है। बट स्टिल शी डिडंट स्टॉप एंड शी स्टार्ट रनिंग रनिंग रनिंग। एंड जब उसने वो
फिनिश लाइन क्रॉस करा तो सब लोग उसके लिए तालियां बजा रहे थे, एवरीबडी वाज क्लैपिंग, सब उसको कॉन्ग्रेचुलेट कर रहे थे। उसको समझ नहीं आ रहा था क्यों, बिकॉज शी वन द रेस, शी वॉज द फर्स्ट वन टू क्रॉस। जो लाउड स्पीकर पर से कंट्री के नाम सुनाई दे रहे थे वो किसी और रेस का, जो उससे पहले रेस कंडक्ट हुई थी, उनके विनर्स के नाम या उनके रनर्स के नाम आ रहे थे। जहां फिनिश लाइन पे सेरेमनी चल रही थी, वो उसकी रेस की सेरेमनी नहीं थी, वो उससे पहले जो रेस कंप्लीट हुई थी उसकी सेरेमनी थी। तो शी वॉज द वन जो अपनी कंट्री से रिप्रेजेंट कर कर फर्स्ट टाइम आई एंड शी वॉन द रेस। एनी यू द नेम, एनीवन नो द नेम ऑफ दैट person, that girl? The name can be anyone. It's a real story of my life. It can be the real story of your life. This name can be Vaishali, the name can be Nancy, the name can be Parth, the name can be Ruturaj, the name can be Ankit Sharma, anyone. So that's not an actual real story. That was a real story of all of us in this race of life. When you are going to complete this course, CA, आपको किसी से compete नहीं करना है कि आपका दोस्त आगे जा रहा है, वो आपसे अच्छे मार्क्स ला रहा है। आपको अपना बेस्ट देना है, अपना बेस्ट। बस अपना बेस्ट करो जितना भी कर सकते हो। ट्रस्ट योर सेल्फ। ये सोचकर मत अपनी रेस छोड़ देना कि मैं इस अटेम्प्ट में नहीं हो पाया तो सेकेंड अटेम्प्ट में भी नहीं हो पाऊंगा, या बाकी लोग मुझसे आगे निकल गए। नो, डोंट थिंक अबाउट इट। जस्ट कंटिन्यू योर रेस, गिव योर बेस्ट, एंड यू विल definitely going to finish the finish line later or soon. So that was not the real story in that sense, but that is a real story of all of our lives. So once you are on the track, you are on the track. You just have to run, complete your race. Later, sooner, it does not matter. But when you will finish the cross line, whenever it will be, there will be people who will stand for you. They will clap for you. They will congratulate that you success in your life and you become a chartered accountant. So please keep running. So moving on to the provision of mortgage and reverse mortgage. The reverse mortgage scheme, before understanding the concept of reverse mortgage, let me explain the mortgage general meaning of this term. Fine. So it works like this, that if Mr. A, having suppose a building, the market value is suppose 30 lakh rupees, he mortgaged this building and suppose he avails 60% loan, which is 18 lakh rupees. This is the loan in the hands of Mr. A. Is it an income of Mr. A? No, it's a liability, so it cannot be an income. So that cannot be taxable because it's a kind of a loan. So it's a part of our liability and we have to pay it off via EMI. So it's a normal loan procedure. Then we took the amount of loan in lump sum and then we paid as per equal monthly installment. So that is my EMI. How we repay it like this with interest. So this is the normal situation, but we are talking about the excuse me, we are talking about the reverse mortgage scheme. It's a different kind of scheme framed by reverse mortgage scheme having some specific characteristics. Reverse mortgage scheme says it is only for senior citizen. Only for senior citizen. In this scheme, the senior citizen will mortgage their property to the bank, and whatever is the value, suppose it's 20 lakh rupees value, then bank will give you a loan of approximate 60%, that means 12 lakh rupees, suppose. That will be your loan amount, but the concept is reverse mortgage. Generally, the loan value will be given in lump sum to you and you have to repay it with the help of EMIs. But in this reverse mortgage scheme, this loan will be provided to you in EMI, in equal monthly installment. So the loan will not be, the sanction amount will be in lump sum, but the disbursement will be in monthly installment. Suppose 10,000 rupees per month. So out of this 12 lakh, you will get 10,000 rupees per month as an installment, as a loan. in the hands of the borrower. And borrower need not to pay. The repayment has been delayed, deferred. You need not to repay anything till you are alive. So this scheme has been framed for those senior citizens who do not have any other source of income, and to survive their life, they need regular income. So to give them loan in lump sum, that can be dangerous because it can be spent really fast. So department has made, the banks, the authority has made a specific kind of scheme that is called reverse mortgage, that we will provide you like regular loan installment, like an income. But that is not actually the income, but it will be given you in equal monthly installment. Your loan will be disbursed like this, and you need not to worry about the repayment. The repayment after your death. Either you can pay before that, if you have the funds, you can pay it to us before that. But if you do not have any fund, then forget about the repayment after death of the husband and wife both. It's not about that if Mr. A and Mrs. A, they took the loan, and if Mr. A died, then it does not mean the government will sell your property. Government will wait, the department, so not the government, the bank will wait till the time of any one of out of these are alive. After the death of both Mr. A and Mrs. A, then the property will be sold by the bank and the loan or the interest will be recovered out of that loan amount. So technically the repayment will be in lump sum. So it's a reverse scheme. Normally the loan is in lump sum, normal scheme, and the repayment is EMI. But this now reverse. So now the repayment will be in lump sum and the loan will be in EMI. That's why it's called reverse mortgage scheme. The question must be, what should be come in our mind will be, what or why we are discussing this topic in capital gain. It is just for clarification purpose that if we are giving our asset on reverse mortgage scheme, so will it amount to come into definition of transfer and capital gain will charge? The answer is no, because it will remain a loan. We are not going to transfer our property. We are just giving it as on mortgage as a security. So reverse mortgage scheme having a different characteristics, that it gives you loan in EMI, but the repayment in lump sum, but still it will remain a loan. It's a liability. So it explains us two provision that at the time of mortgage, that will not be considered as transfer. So there will be no capital gain concept applicable at the time of reverse mortgage. The amount received in EMI will not form part of your income. That is exempted under section 1043, because it is exactly as a kind of a loan, but in installment. So it will still remain the liability. So it will not fall in the definition of income. At the time of repayment, the bank will recover the interest as well as the principal amount. So the interest part will be taxable at the time of repayment. At the time of auction of that property will be the bank PGBP income. So basically there are three concepts we need to understand. The EMI paid as a loan is not an income. The property transfer under reverse mortgage is not a transfer. The interest income what bank will receive at a time of repayment, etc., that will be interest part will be bank PGBP income. So that is the whole scenario in case of reverse mortgage scheme. This has been explained over here. Step 1, borrower hypothecates the house to the bank. Mortgage will not be transferred, so no capital gain provision will be applicable. Step 2, borrower receive monthly loan installment for the loan duration. Installment will not be regarded as income as exempted under section 1043. Ownership of the house vests with the borrower still, because there is no ownership transfer. That's why it's not a transfer definition concept. Step 3, borrower dies. House loan repaid by legal heirs, house handed back to the legal heirs, or house sold and loan repaid to bank. Bank receive repayment of loan plus accrued interest, and only interest will be treated as bank income. Clear? These are the provision in theoretical part. You can go through it and read the provision. If there is any confusion, I will explain you. So the whole story I have just discussed with you has been written over here. The main concept, section 47 says it is not a transfer. Section 1043 says it's not a income. Example, Mr. A purchased gold in 1970 for 25,000. In the previous year, 23-24, he gifted it to his son at the time of marriage. FMV of the gold on the day the gift was made was 1 lakh. So it's asked whether the capital gain will arise. No, the gift is outside the taxability of capital gain as per section 47. We have the answer, of course, over here. A house property is purchased by a Hindu undivided family in 1945 for 20,000. It is given to one of the family members in the previous year 23-24. At the time of partition of family, FMV on the date of partition was 12 lakhs. So any property received by the member or transferred to a member by a HUF at the time of partition will not constitute as capital gain. It is exempted transfer. Point number 3, that is B purchased 50 convertible debentures of 40,000 in 1995, which are converted into 500 share worth rupees 85,000 in November 2020 by the company. For this, we have to refer point number 14 on page number 20. That will be discussed on point number 14. So third case, we are skipping. Mr. Abhishek, a senior citizen, mortgaged his residential house with a bank under a notified reverse mortgage scheme. He was getting loan from the bank in monthly installment. Mr. Abhishek did not repay the loan on maturity. So this is the example regarding the reverse mortgage scheme. You can read it. It's very simple. They are asking whether it's transfer capital gain or whether it's income, whatever EMI you are receiving as a loan. That cannot be treated as your income, and mortgaging your property for the purpose of reverse mortgage scheme will not amount to even transfer also. Next examples for true and false, you can read, you can go through it. If there is any confusion, I will solve it for you. The definition of amalgamation. We have discussed what is the meaning of amalgamation with the help of an example. Here is the definition which says all the property should be transferred, all the liability should be transferred. Shareholding, holding 3/4, that means 75% should remain the same. This is the definition of demerger. You can go through it. Same conditions almost. Demerged company meaning, resulting company meaning. Now we are moving on to point number 14 and 15. After point number 14 and 15, our section 47 will be completed. The transfer which are not regarded as transfer. We are still reading the provision of section 47. So this is point number 14. This means exempted capital gain. मिस ममता यादव आस्किंग, सर ये लोन सिर्फ एज्ड कपल्स ही ले सकते हैं क्या? ओनली 1% आपने बिहाफ पर नहीं ले सकते? मिस ममता, ये जो रिवर्स मॉर्गेज स्कीम है ये सिर्फ और सिर्फ सीनियर सिटीजन्स के लिए है, 60 साल से ऊपर वालों के लिए। हस्बैंड वाइफ में से कोई भी एक अगर 60 साल से ऊपर का है तो ये स्कीम ले सकते हैं। कोई एक हो तो ये स्कीम आपको बैंक से मिल सकती है। अगर आप 60 साल से नीचे हैं तो ये स्कीम आपके लिए एप्लीकेबल नहीं है, ये सिर्फ उन्हीं के लिए मिली। ये जनरली, फॉर एग्जांपल, एक वो मूवी थी ना बाग, उस वाले केसेस के लिए है जब पेरेंट्स को जनरली कोई इनकम सोर्स नहीं बचता है पेरेंट्स के पास, तो गवर्नमेंट ने ये अच्छी स्कीम चलाई है कि आप अपनी प्रॉपर्टी को मॉर्गेज कीजिए, हम आपको एक साथ लोन नहीं देंगे। अगर एक साथ लोन देंगे तो वो जल्दी खर्च हो जाता है, रिलेटिव्स ले जाते हैं और किसी तरह से भी एक्सपेंस हो सकता है, फिर बाद में आपके पास उसको रीपे करने का पैसा नहीं होता। तो ये स्कीम रिवर्स मोड में चलाई जिससे आप अपनी रेगुलर इनकम ईएमआई फॉर्म में बैंक से लेते रहें एज अ लोन, और बाद में आफ्टर डेथ या तो आपके लीगल एयर्स आके प्रॉपर्टी लेकर बैंक का लोन इंटरेस्ट चुका दें तो वो प्रॉपर्टी उन्हें दे देंगे। अगर वो नहीं होता है तो बैंक उस प्रॉपर्टी को ऑक्शन कर अपना इंटरेस्ट और प्रिंसिपल अमाउंट आपसे रिकवर कर लेगी। ठीक है। पॉइंट नंबर 14, एनी ट्रांसफर बाय वे ऑफ conversion of bonds or debentures into the shares or debenture of the same company. So if you are having any kinds of bonds or debenture, convertible bonds, convertible debenture, and you convert them into the shares or the debenture of the same company, in that situation, that conversion will be exempted from the capital gain provision. Any transfer by way of conversion of preference share into equity shares of the same company. And if even if you have preference shares and if you convert those preference share into equity share of the company, that is also exempted in the definition of transfer. In this case, the cost of acquisition of shares or debenture received on such conversion shall be the cost of that part of debenture or bond which is so converted. That is new cost of acquisition. Period of holding in case of shares will be counted from the date of allotment of shares, that is new period of holding. If preference shares converted into bonds or debenture, that is amount to transfer and capital gain will arise. Only if preference shares, if converted into equity shares, that is not taxable as capital gain, but if preference shares has been converted into debenture or bond, that is going to be taxable capital gain. Let me give you an example for that. It's very simple. Suppose there is Mr. Iron Man. He purchased convertible debentures, 1000 convertible debentures for rupees 5 lakh on 1st April 2010. Clear? Now, out of these convertible debentures, these are numbers. This is value. Now, out of these convertible debentures, suppose he will convert in the ratio of 2:1. Against 2 convertible debenture, he will get 1 equity shares. So that means number value. So he was having 1000 convertible debenture. Those value was 5 lakh rupees. Now after conversion, in the question, the ratio will be given. This is before conversion. So on conversion, he will receive in the ratio of 2:1 the equity shares. So he will receive 500 equity shares against the debentures. And the question says 60% of value of debentures converted into equity shares. So the 5 lakh rupees value, which was the cost for the purpose of convertible debentures, out of this 5 lakh, 60% value has been converted into equity shares. So this 500 equity shares value has been converted into 60% of this. So the 60% of debenture value, that means 3 lakh, will be the cost of acquisition for equity shares. Suppose this conversion has taken place on 1st April 2016. So this conversion is exempted as per point number 14. So at the time of conversion, there will be no capital gain chargeability. Clear? So after conversion, this is before conversion, you have 1000 number of debenture, value was 5 lakh. And after conversion, now you have 500 equity shares, value 3 lakh. And what is now debentures situation? Now debenture will remain 1000, but the value will be only 2 lakh rupees. Because out of this 5 lakh, 60% has been converted in the value of equity shares. So balance 40% will remain the value of debentures you have. So the final position is now this, that you have equity shares 500, value 3 lakh, you have 1000 number of debentures. Still debenture number will not change. In that proportion you get the new equity share, but does not mean in exchange you get the equity share. You converted the value of debenture. You did not convert the number of debenture into equity share. So number will remain the same, but the value of debenture will be reduced from 5 lakh to 2 lakh rupees. So now the question says, suppose that Mr. Iron Man sold all debentures and shares at the rate 1000 each on 1st April 2023. Because the conversion is exempted, so we will not do anything, as we did not do anything in exempted transfer cases in the above 12 cases. This is different because in this case there is value change of some asset into some other asset. So now we solve this provision, capital gain calculation, in the hands of, there is no previous owner case, no assessee case, because the owner will remain the same in this situation. In this situation, asset converted, not the owner. In those 12 cases, there is change in ownership in most of the cases. Mr. A, then Mr. B, then Mr. C. In this case, there is no exempted capital gain of that kind in which assessee change. Ownership remains with Mr. Iron Man, but the nature of asset has been converted. So capital gain in the hands of, he is the previous owner, he is the assessee, there is no change. In case of Iron Man, for assessment year 24, 25, 24, 25. Okay. So now period of holding, we have to calculate, we have to solve two asset cases over here. One is debentures and one is equity shares. How many number of debentures we have? We have debentures number 1000 still the same, and equity shares numbers are 500. Period of holding for both we need to find out. Debentures we purchased on 2010 and sale in 2023. So that is 2010-23. That means long-term capital asset. Clear? Shares we received on conversion date, that was 2016. So shares we receive on 2016 till 23. There is no concept of previous owner, Manjula Desha, that is not applicable in conversion case. That's why point number 14, 15 is different from point number 1 to 12. That's why the clarification of point number 14, 15 is separate from point number 1 to 12 clarification. So we have period of holding of both, we have long-term capital asset. Now the second step is sale consideration. So question says that we sold all shares and debenture for 1000 each. So that means number of debenture 1000 and each has been sold for 1000. That means we have the sale consideration 10 lakh rupees for debenture. This is 5 lakh rupees. Now the cost of acquisition or index cost of acquisition. You might have remembered that debenture cannot have the benefit of indexation. In the note number 2, I guess, no debenture and bonds need to be indexed except the capital index bond and one more that is specified by the government. So these are normal debenture and bonds, so we cannot index it. So we will take cost of acquisition in case of debenture. Now, what is the cost of acquisition? I've told you this, not the 5 lakh, because 5 lakh 60% has been converted into shares. So remaining will be my cost of acquisition in case of debenture. 2 lakh will be my cost of acquisition and 8 lakh will be long-term capital gain. For the purpose of equity share, there will be indexation done. Index cost of acquisition we have to calculate. Fine. The next cost of acquisition, take the cost of acquisition, which is 3 lakh. The 60% part, 3 lakh into 348. And for the purpose of division, we will take that year in which the allotment of equity share has been made. That in the year in which conversion has been taken place, which was 2016. So 16-17 index will be given in question. After putting the value over here, we need to calculate the long-term capital gain or loss as the case may be. So in case of conversion, there is no concept of Manjula J. Shah. There is no concept of previous owner or the assessee. The assessee will remain the same. In the conversion question, you have to convert the value and the number where carefully. The question will say a certain percentage of the value has been converted. So the new value will be the value for the purpose of shares, and the balance value will be the value for the purpose of that security which has been converted. The number will be changed as per the ratio given in the question, and that will not affect your number which has been given in the question for debenture as well as the shares. So that's why you can see that the clarification has been given for this only for point number 14 and 15. So these clarification is not applicable for point number 1 to 12 because their clarification is separate. Now we can again read the clarifications, so you will get the meaning of the clarification exactly. The cost of acquisition of shares, that means converted value or debenture received on such conversion, shall be the cost of that part of the debenture or bond which is so converted. So what will be the cost of the new converted asset? So that part which has been converted, like 5 lakh was the debenture value, 60% has been converted. So that 3 lakh will be the cost of acquisition for that security which is being converted. Period of holding of the new security will be taken from the date of allotment of shares, of course. If preference share converted into bonds or debenture, that will be capital gain. At that time only, we need not to exempt that. Now, very simple provision. The very important part was point number 1 till point number 15 we discussed. The numerical will be framed from this point number 1 to point number 15, and you have to find it out whether it's a point number 14, 15 question, conversion. That clarification, these clarification will be applicable. And if it relates to point number 1 to 12, then those clarification regarding the Manjula J. Shah, the previous owner, the period of holding will be applicable. Now the new case before 1/4/2014 and after 1/4/2014, if any amount has been forfeited against any asset, then there is no treatment in the capital gain head. Before 1/4/14, there was treatment under capital gain head. We do not need to discuss it. We are just focusing on the provision which is now applicable on or after 1/4/2014. So if there is any amount forfeited on any capital asset on or after 1/4/2014, then the amounts of forfeited will going to be taxable as income from other source. There is no treatment in the hand capital gain. Next, transfer of capital asset by a partner to a firm, section 45(3), and the section 45(4) is transfer of capital asset by firm to its partner or member on dissolution or otherwise of firm, AOP, BOI, etc. So there is a very simple provision, section 45(3) and 45(4), very simple provision. They just explain about the sale consideration. So we are discussing sales consideration in two situations. Sales consideration in two situations. One is when partner transfer asset to firm under section 45(3), and when firm transfer any asset to its partner under section 45(4). So in this situation, if a partner transfers asset to a firm, then what will be the sale consideration? The sale consideration will be the book value, or the value in which the asset has been recorded in the books of accounts of the firms. That is called book value. So the value on which that asset has been recorded in the books of the firm will be called the sale consideration for the purpose of partner. All provision will remain the same, like period of holding, like partner purchase an asset for 10 lakh rupees in the year 2006 and transfer this asset to the partnership firm on 2023. Fair market value was 8 lakh, but we record in the books the value 6 lakh. So 6 lakh will be the sale consideration. Period of holding will be from 2006 to 2023. There is no difference. Index cost of acquisition considered will remain the same. 10 lakh will be your cost. Index is 348. Division index will be for year 2006 or 7. That will be given in question. You have to solve it like this. So all other provisions are same. We just trying to understand what will be the sale consideration. So whatever will be recorded amount in the books of accounts of the firm will be the sale consideration in this situation. And when firm will transfer any asset to partner, then the sale consideration will be the fair market value. Suppose firm transfer any asset to partner, which fair market value is 50 lakh and book value is 20 lakh. And suppose the price charged, actual price charged by the firm is 35 lakh. So in that case, they both are irrelevant. The fair market value will be the sale consideration. Less cost acquisition, period of holding provision will remain the same. So section 45(3) and 45(4), they just explain what should be the sale consideration in these two situations, when partner transferring asset to firm or vice versa. These are provision already has been written over here. Section 45(3) shall be chargeable to tax in the previous year in which transfer took place. The amount recorded in the books of firm will be deemed as sale consideration. Sale consideration, book value, amount recorded in the books of the firm, normal cost acquisition or index, improvement, same provision. 45(4) shall be chargeable to tax in the year in which transfer took place. FMV will be the sale consideration. You can see the format, numerical treatment, FMV, then cost, index, same provision. There is no difference. Next is scope and year of chargeability, section 45. Generally, section 45 says, the charging section of capital gain says that when there is a capital asset and when there is a transfer, we calculate capital gain in the previous year transfer took place. So we calculate capital gain in the previous year transfer took place. But there are some cases in which we will not calculate capital gain in the year transfer took place. We will calculate capital gain in some other year. We will defer the capital gain chargeability. Defer. So we will not going to calculate the capital gain in the year of transfer in some cases. Why? Because there is some genuine reason. We cannot calculate capital gain in the year of transfer. So we calculate capital gain in some other year. When we do this, what are the cases? Why are these cases? What is the concept? That is going to be discussed under section 45(1). As point number 1 till 15 was very important from the point of view of numerical questions. In the same way, this section 45(1), scope and chargeability year different, is also very important. There are two sections which is very, very important, section 45(2) and section 45(5). any profit or gain arising from transfer of a capital asset effected in the previous year, other than exempted, like point number 1 till point number 15, shall be chargeable to income tax under this head in the previous year in which the transfer took place. That is section 45 says. But following are some of the exception of this case. First one is conversion of capital asset into stock in trade. You might remember that in the definition of transfer, section 247, the first point was sale, exchange, and relinquishment. The second point was extinguishment. The third was compulsory acquisition under any law, section 45.5. And I told you that we will discuss section 45.5 in detail later. And the fourth point was conversion of capital asset into stock in trade, section 45.2. And that is also, I said that we will discuss the provision later in detail. So that is section 45.2, which says that if any person convert his asset into stock in trade, there was same provision in PGBP in which we were converting our stock in trade into capital asset. So in that situation, the FMV at the time of conversion will be taken as the sale consideration for the purpose of PGBP. Same almost provision over here. Now the vice versa. If you are converting your capital asset into stock in trade, then it also amount to transfer. And capital gains should be charged. But there is a problem. There is a practical problem. What is the practical problem? Let me explain you with the help of an example. Let me think, is there any query? So, practically there is a problem, and what it is, suppose there is Mr. D, who is a doctor, Dr. Strange. Fine. So, he is doing his practice as a doctor. Now, he purchased 3 buildings for 10 lakh rupees each. Clear? And that has been purchased on 1st April, suppose 2010. So, because he is a doctor and he is doing his practice as a doctor, so these as buildings are his capital asset. Now, Mr. D start a business also as a builder. So he will deal in now buildings. He will sell, purchase, building also. So what he did, he transferred this capital asset as his stock in trade in this builder business. He transferred this capital asset, or we can say convert. He thought, why should I bought new capital asset, new buildings? First of all, I want to sell these buildings, which I have as a capital asset. So he converted these capital asset or introduced these capital asset as his stock in trade. So that will be called conversion of capital asset into stock in trade. And this has been done on 1st April 2016. So because there is a capital asset and there is conversion, and we treat conversion as transfer in the definition of transfer. So that will be called transfer date. Suppose the FMV of these buildings at the time of conversion was 40 lakh rupees each. So if theoretically we will see, then we have 30 lakh rupees gain on each building. 10 lakh rupees the purchase price, each building, 40 lakh is the selling price of each building. Forget about the indexation. Suppose, forget about the indexation, then we have literally 30 lakh rupees profit in one building. So technically we have 90 lakh rupees profit. If we're going to calculate the capital gain, that will approximate 90 lakh. Forget about the indexation concept for right now. So for this 90 lakh rupees, he's technically having 90 lakh rupees profit because he converted that, and conversion has been covered under the definition of transfer. So because it's transfer of a capital asset, so technically on papers, he is having a gain of almost 90 lakh rupees. And on this 90 lakh rupees, the long-term capital gain tax rate is approximate 20%. That means almost 18 lakh rupees tax he needs to pay in the year 2016. So suppose income tax department comes to Mr. Dr. Strange and ask him to pay 18 lakh rupees tax in this year. Now the question arises, as per the provision, we are doing the correct. Here is a capital asset. Here is a transfer in the year 2016. So income tax will charge capital gain of 90 lakh rupees and will ask him to pay 18 lakh rupees as tax. Surcharge says, forget about it. Almost 18 lakh rupees tax. Now, does he really have the money in his pocket? After conversion, will he receive any money in his pocket? Or it's just a book entry? It's just a book entry. It's like something like this is happening. Earlier, it was his fixed assets in the balance sheet. Over here, 10 lakh rupees each, 30 lakh rupees. And he just did what? Now the fixed assets has become the current asset, converted, because now it's a stock in trade. So by doing this, is he earning any practical income into his pocket? The answer will be no. Because he just changed the nature of the asset in his books of account. It does not the real inflow of money into his pocket at this time. But so suppose if income tax comes to your house now and asks you to pay 20 lakh rupees almost as a tax, 18 lakh rupees. So you will say, I do not have money. So income tax say, how? You have money. You have 90 lakh rupees profit as per according to us. Because you have converted your capital asset into stock. And for the purpose of this, we have made the provision that it is a capital gain and you have to pay tax of 20 or 18 lakh rupees. So the Dr. Strange says it is not possible me to pay because I do not have any real cash flow of money yet. So income tax understood this. They say yes. The transfer here is this. Very correct. There is a capital asset. There is capital gain in this year. But we cannot recover the tax from the assessee in this year because he does not. That in case of conversion of capital asset into stock in trade, there is capital gain in the year 2016, but we will charge tax. The chargeability has been deferred. The recovery of tax is deferred. The chargeability will be in the year in which stock will sell. So income tax says we will wait till the year the stock is going to be sale and you will have the real inflow of money. So now suppose Dr. Strange sold these stock in trade on 1/4/2023. 2 properties has been sold. Not 3, only 2. 2 has been transferred at the rate 75 lakh rupees each. So now in this year, capital gain will be charged. Understood? So now if we will solve this question, then we have to write computation of capital gain in the hands of Mr. Dr. D for assessment year 24-25. But remember, this 24-25 is just the chargeability year. Transfer has been done in this year, 2016. So all the provision will be applicable according to this year. This is only the recovery has been deferred. The capital gain has been applicable in the year 2016, but because you cannot pay the amount of money in this year, so we are just waiting. We are just waiting that let the time come when you will get the actual money, then we will charge the tax. But all the provision will be applicable as per this year. So once you write down the year 2024-25, let me tell you a trick to solve these kind of question. You should write the year of chargeability, then forget about 24-25. All the provision, just forget about this information. We do not need this information anymore for the purpose of calculation of capital gain. Just forget about this year sale. Just consider only these conditions. These two conditions we need to take. So if we talk about the period of holding, so we will take from 2010-2016, not 23, because this has been converted into stock. We need to take the year till which it was a capital asset. So this will be my transfer year. So that year will be 2016. Always remember, students generally write it down 2023 in hurry. So please, I advised you, forget about this information. Once you write down the assessment year, forget about this. You have to solve all the provision only till this date under the capital gain provision. What should be the sale consideration? The provision says the FMV on the date of conversion will be sale consideration for the purpose of capital gain. Same as in case of PGBP. If stock has been converted into capital asset, then the FMV on the date of conversion is PGBP income. In the same way, asset has been converted into stock, so FMV at the time of conversion will be the sale consideration. Only two properties have been sold off, so only two properties capital gain need to be calculated. What was the FMV on that date? 40 lakhs. So sale consideration will be 80 lakh rupees. Clear? Do not take this 75 lakh. I have told you again, forget about this information after writing down the assessment year. Now, the index cost of acquisition, because it's a long-term asset and it's a building, so we need to do the indexation concept. Now, maximum student do mistake in this solution. What is the cost of acquisition? That was 10 lakh each. So for two properties, this is 20. Maximum student write it down 348. Because we were practiced to write it down always 348, 348, 348. So in definitely a lot of students going to do this mistake. Please listen it carefully. It's not 348 fixed. It's the transfer year index. Generally it happens that transfer year is 23, 24 in our question. So we take it 348. So it's a practice, it's an habit that we generally write it down 348 without seeing anything. But in case of these special provision, remember that cannot be 348 because transfer year was this. This is stock transfer year, but asset transfer year is 2016-17 index. That will be given in question. You have to write it down 16-17 index. And of course, purchase year index is simple 2010-11. So that whatever amount will be there, that is going to be deducted. Now we will have our long-term capital gain or capital loss. One property has been left. Suppose one property, the third property has been sold at the rate 100 lakh rupees on 1st April 2026. So that is going to be chargeable to tax in assessment year 27-28. We just need the year, that's it. Forget about everything. Now the sale consideration is 40 lakh will remain because that was FMV value. Then for cost, that will be 10 lakh, one property. Index will remain 16-17. Lower index will be 10-11. And that will be capital gain, long-term loss or gain. So always remember, if the asset has been converted into stock in trade, then the year of conversion will be your year of capital gain. The FMV will be your sale consideration. We just need to wait till the year in which stock has been sold. The year we need for the purpose of calculation. All the period of holding, all the indexation, all concept will be applicable till 2016. So that will be capital gain. But the last thing in these kind of question, examiner will also ask calculate PGBP income because stock has been transferred. So capital gain we have calculated, but for the purpose of PGBP income, we need now this information. because stock has been sold. So how to calculate the PGBP income? It says sale price minus purchase. So what is the sale price of this property if we need to calculate PGBP for this year? So sale price was 75 lakh each. So that means 150 will be the sale price. And what will be the purchase? The FMV at the time of conversion will be the purchase. Or you can say, what is going to be the sale consideration over here for the purpose of capital gain? That is going to be the FMV for the purpose of purchase, for the purpose of business income. So for assessment year 24-25, the PGBP income will be 70. And for this year, assessment year, this year, PGBP income will be 100 lakh was the sale consideration. Whatever will be your sale consideration for capital gain will become the purchase price for the purpose of PGBP. That will be 60 lakh PGBP in this year. So this is a very important question for the purpose of examination. And that is very simple. You just need to understand one thing. That technically capital gain is this year. But because we do not have the real money of flow, so the deferment of taxability has been just changed in the year in which this stock in trade has been sold. So we just need the assessment year for the chargeability of capital gain in this cases. Everything else will be taken assuming that this has been transferred in 2016. For the purpose of PGBP income, the sale price minus the FMV at the time of conversion will be the purchase price. So that will be your PGBP income, and these are your capital gain income. And these are the provision regarding it. A person who is the owner of a capital asset may convert the same or treat it as a stock in trade of the business carried on by him. As noted above, the above transaction is a transfer. As per section 45(2), notwithstanding anything contained in section 45(1), being the charging section, the PGBP from the profit and gains arising from the above conversion or treatment will be chargeable to income tax as his income of the previous year in which such stock in trade is sold. So chargeability will be done in the year stock has been sold. What will be the consideration, sale consideration for the purpose of asset? That will be the fair market value at the time of conversion. Capital gain arising on conversion of capital asset into stock in trade shall be chargeable to tax in the previous year in which stock in trade is sold by the assessee. FMV on the date of conversion will be the sale consideration. Here is the numerical format. House purchased in 2012 for 10 lakh and converted into stock in 2016. FMV was 30 lakh and the house sold for rupees 5 lakh in May 2023. So transfer year will remain 2016, but capital gain chargeability year is May 23. So previous year 24-25, period of holding remain the same. FMV on the date of conversion, that was 30 lakh, will be the sale consideration. Index cost of 10 lakh we need to calculate. Then there will be our capital gain or loss. So let me take if there is any more question. Sir, you have watched Avengers movie a lot. Yes, I have seen all the Avengers and these kind of fiction movie. I am a big fan of those movies. Okay. So that was till the provision of conversion of capital asset into stock in trade. Kindly revise the provision. Our next class is day after tomorrow, in which we will cover the remaining provisions of part A, part 1, what we are discussing in capital gain. There will be an MCQ test also. So I request you, please revise twice. That's my advice to make you wise. If there is any query, you can ask me in the next session. So have a very good day and please study hard. Focus on your goal. Remember that story I told you today. This is your race. You have to win it. And you do not bother about the other person, what they are thinking, what they are running. There might be your friends, those are ahead of you. There might be some, those are after you, but you are yourself. You have to focus on your race, and I believe you will win at the end. So Manishji, can we conclude the topic today?